Welcome back to Fast Market here on the Schwab Network. It's time for cash tags. For that, let's bring in our next guest. That's Landon Swan, co-founder of LikeFolio. Welcome back to the show, Landon.
Thank you. It's great to be here.
All right. So we've got Walmart reporting tomorrow morning. You know what, Landon, the last 3 quarters, you think the stock's overbought. It's run so far. I mean, 2 years ago, the stock was $45, but they continue to navigate the consumer, whether it's the high end, the low end. It just seems like it's recession proof. It's good, good economy proof. It just seems to be doing everything right at this point.
Yeah, this is like an investor's dream for the last year. I mean, it has just ticked up slightly a little bit every week, just kind of drifting upward, has good report, goes up a little bit more. I mean, the 1-year chart on this is just like, it's beautiful. I mean, it is just so steady. If you're in Walmart and you're not happy, then you shouldn't be in stocks at all, because that's what you want right there. Yeah. And I tell you what, they had a great earnings report last quarter. They beat on earnings and revenue. Revenue was up 5.5%. U.S. sales were up 5%. International were up 8%. Sam's Club even did well. They're up 4%. So the stock moved up about 6% over the week following earnings, and since then it's up another 20%. So you have to think expectations are high, but just like you said, you've been saying that for 3 quarters now, and they just continue to do well. They're just steady and they're just cranking out cash. They're doing a great job. Now, when we look at some of the data, it supports this. I mean, largely it says that the data is supportive of Walmart doing well. When we especially look at web data over the last little bit, over the last 30-day moving average, it's improved from 11% to plus 14%. If you look at that versus Target, it's not doing as well. Target's kind of showing them up a little bit, but overall, they're plus 14% on a year-over-year basis there. Sam's Club is not doing as well. It's the one that's losing here, as you can see. And if you kind of pair these up, so think about Sam's Club versus Costco. Sam's Club's losing that battle. Target versus Walmart, Walmart's losing that battle, but they're still doing well, especially when you throw Shipt in there. Shipt's kind of the outlier there, primarily associated with Target. So Walmart is doing well, and it's justifying this nice run up. But what's really interesting to me is the difference between Walmart and Target, especially when you look at the stock charts. I mean, Walmart has been, like I said, steady Eddie, and Target's not so much. So Target reports in a couple weeks. I'm really looking forward to that one, especially seeing how Walmart reacts. But right now, what we're seeing is Walmart's justifying all the moves. We've kind of got it priced right now. We don't see a big discrepancy between what they're reporting, what we're seeing on social media, web data, app data, all of that. We don't see a huge discrepancy versus their stock price. So in line is kind of where we're at so far with Walmart. And when we look at the app engagement up 5% on a year-over-year basis, they're really actually doing a good job in getting into technology. They're actually using AI to start doing some price forecasting, especially on produce, looking at weather, climate, supply chains, things like that, to help them. So they're very, technologically advanced. They're using technology to their advantage, and it's actually showing up in a better app experience where they're getting more users in. So that they've done a great job of getting people digitally involved. Their online sales are up 27%. So just overall, the company is doing very well, priced to near perfection, but they just keep executing perfectly. So it's tough to find an edge on this one.
Landon, you're right. This company does a lot of things well, but let me help you with your discrepancy column. So here's the stats that give me pause. 89 straight quarters, their price to sales was below 1 times, right? Last 2 quarters, it's been at or above, and if they hit their numbers, 53 cents and 180.2 billion in revenue, if they hit those numbers, it's 1.22. So it'll be significantly over 1 times revenue price to sales. Now, here's the other. First quarter of 2024, the PE ratio was 25. If they hit their numbers of 53 cents and 180.2 billion, it'll be a 41 PE. I mean, that is, for a company with 8 billion shares, that is an amazing overvaluation, unless we're completely changing the way this company is valued. I don't, but it's incredible how far, it's popular and it's lean, and their e-commerce is getting better, their alternative revenue is getting better, but Landon, the valuations. Back to you.
I agree. And, I think you once told me, Kevin, that you take the stairs up and the elevator down. And when it comes to things like that, it's always a creeping valuation, right? And then eventually one of the big funds says, you know what, we're 20% higher on valuation than we were a year ago. Let's get rid of some shares, and then bad things happen with the stock. It's a great company. We're fairly neutral on it because of the run that it's had. I mean, we just don't, it's tough. If you just look at the data, we'd say this looks pretty strong. We think they're going to have a good report, but clearly we're not alone. Everyone thinks they're going to have a good report, and they've been buying the stock up, pushing it, like you said, to these higher valuations. What I'm really interested in, this is I'm going to predict a pretty specific series of events here. Walmart puts out good numbers, sells off a little bit because of the valuations that you're talking about. Target gets a sympathy sell-off, and then in a couple of weeks when Target reports, they surprise and beat to the upside because of that lowered expectations. That's kind of the play out that I want to see, because the data that we've got has Target beating Walmart in just about every category. Walmart goes first here, and they're overvalued, whereas Target has been taking it on the chin a little bit with the stock. So those two, watching them back to back, I think the setup is there for the scenario I just laid out.
Yeah, and some of their competitors have had that same. Costco, I always equate it to that. It fell post-earnings last quarter and then rallied immediately after due to some of the numbers. And you know what, Landon, this neutral rating that you guys have on it, it makes sense. But, Kevin mentioned a lot of the fundamental stuff, but their margins have been growing. In the retail side, where margins are so thin, they continue to expand margins, and that's probably based on the technology that you mentioned, right?
Yeah, absolutely. They're doing a great job with technology, growing margin, like you said. And another thing to think about is, if you're a fund and you've got to put your money somewhere, yes, I agree that it is a little overpriced, but you got to find a better place to put it, right? And if you're worried about inflation and you're looking at these margins growing and you know that they've got pricing power, then it seems like a safe place to put your money until it's overvalued, right? Until they say, you know what, 1.2, 1.25. Now we're getting to that number that you talked about, Kevin. Let's get out of it. Until that point, it's safe to be in there. So it's tough. I mean, earnings score on this one, we've got a +4. It's basically 0. I mean, we don't have a position on it. I wish that we had bad data so that we could, smash the sell button on it and play some puts, but we don't have bad data. We've got good data, but the stock is just so high that it just matches up. Basically, that's where we're at right now.
Yep, dare to bet against the consumer, especially the Walmart consumer. All right, great stuff. As always, Landon, have a great day.
Thank you, guys.
All right, that's Landon Swan, co-founder of LikeFolio. Kevin,